Hello everyone and welcome to my channel. So today we are going to talk about what is margin trading. So as you know, as you have heard, if you are into trading, that there is a concept called margin trading. Okay, this is mostly used in the intraday positions. Okay, for the day trading sessions. So let's understand what is this, and before getting into the video, just subscribe to my channel and let's get started. So here's a definition on Google that margin trading is a method of trading assets using funds provided by the third party. When compared to the regular trading accounts, margin allow traders to access greater sums of capital, allowing them to leverage their position. So here there is a funds provided by the third party. Okay, so who is the third party? Your broker. What is margin? That if a stock is trading at, let's say, 500, but if you use margin, you don't have to give the full money, that is 500, for taking the position of the intraday for that stock. Okay, you just have to pay around 100 rupees. Okay, why? That is the margin comes, that is when the margin comes. So let's go into a margin calculator of a broker I know. So let's get into it and let's calculate the margin. Okay, there is a calculator which can calculate the margins. Your broker must have a calculator also. You can check it out in the Google. So let's get into it. Okay, so here are we. So this is a margin calculator, so let's calculate it. Let's say the exchange is National Stock Exchange, segment is equity, ticker, that is the stock. Which stock I'm selecting? Let's say I select uh, um, Tata Steel. I guess Tata Steel is trading at 700 something. Okay, last I checked. So let's say I take one quantity. Okay, for intraday. Okay, this is for intraday. I want to take one quantity, so I add it. Let's first delete this and let's add it. So here you go, Tata Steel equity is 1 price. Its current price is trading at 714. Okay, so here you go. See, I don't need to pay the full amount, I just need to pay the 71 rupees for one quantity. Okay, and if I want to trade for 10 quantities, I need to pay 71 into 10. Let's add it, delete, add. Here you go, 714 rupees. See, this is the margin. And what about that? Why your broker gives you this amount? Because there is a upper circuit and a lower circuit. I have explained in the previous video. The stock cannot goes beyond the upper circuit uh, or below the lower circuit. Okay, so that a stock cannot break in a day for intraday trading. When a stock hits the upper circuit, the trading stops for that specific stock. Let's suppose Tata Steel has a upper circuit limit of there is mention of the upper circuit and the lower circuit in your broking account, especially in India. Okay, so the value, let's say this price has a upper circuit of 850, okay, and a lower circuit of 648. Okay, the stock price cannot go above 850 and cannot go beyond less than 650. Okay, so that's why what the broker does is broker purchase this, okay, 714, and gives you leverage position of rupees 71. As I have said, like if I purchase one quantity, let's delete it, let's add. Okay, so if I purchase one quantity, I don't need to pay whole amount. I have to pay only, okay, sorry, two quantities, yeah, one quantity. I need to pay only 71. That is, if you subtract the upper circuit minus this value, okay, you will get this amount. That is only what broker is asking for, because broker knows that your value is not going above or not going beyond that thing, that circuits. So what broker charges is this amount, okay. And if this amount goes higher, if you purchase the stock, let's say you bought it at 71 and sold it at 750, so the profit you keep it with you, and you give the stock back to the broker, okay. That is the simple thing which is margin trading in here. Thanks for watching, and I will come up with more interesting topics, and we'll be covering about some of the digital marketing techniques also. So do subscribe to my channel and like this video, and thank you. Have a nice day.